From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first Friday in March 2025. Well, the spring training games are underway for the Brewers in sunny and warm Arizona. The Bucks continue their playoff push at the Fiserv when the Orlando Magic come to town Saturday, followed by Cleveland on Sunday, and the Lakers are making their one and only visit to Milwaukee on Thursday. And it's that time of year, the Milwaukee Journal-Sentinel Sports Show. Remember the Journal-Sentinel? Heck, do you remember newspapers? All right, let's get started. Talk about an accounting error. Citigroup, one of America's big four lenders, mistakenly transferred $81 trillion into a man's account instead of the $280 he requested. And after it was double-checked, too, it was still $81 trillion. The error was not found until the next morning when it was checked a third time. So would you like that in 50s or 100s? Someone broke into a church in England and stole 4 valuable framed paintings. One of them was the 8th commandment, thou shalt not steal. If you're a godless crook who's into irony, how could you resist this? And finally, from the New England Journal of Medicine, a burning sensation in a woman's legs turned out to be slug parasites migrating to her brain. Quick, someone call RFK Jr.
Oh.
I think we'll end it right there. Okay, on the podcast today, we have Tom Pappenfuss, Joel Driesing, and wrapping up the week. Here's Kyle Tedding.
Well, thanks, Max. A rough week for the stock market. NASDAQ down 3.5%, down 651 points on the week. S&P 500 down 3.1%. That's 184 points, finishing at 5770. And the Dow Jones Industrial Average down 2.4% on the week. 1,039 points, although it was up 223 points on Friday, so adding back a little of what we had given earlier in the week. Finishing the year now, down 5.7% for the NASDAQ, 1.7% for the S&P, including dividends, and the Dow Jones Industrial Average still positive as some of those non-Mag 7 stocks have held up a little better. Importantly, the benchmark 10-year U.S. Treasury closes the week at 4.32%. We've seen some give back on the year that's allowed bonds to maybe help hold up a little better, even as we've seen some decline in some of the growth areas of the market. You know, Tom, I think as we look at markets this week, it's clear that investors have gotten a little grumpy about some of the uncertainty that's out there. I think grumpy, in some cases, maybe an understatement. We've seen some pretty big shifts in some areas. And in others, maybe it doesn't seem quite so bad. Value stocks in particular holding up. And you look across the board, consumer staples have actually recently had a pretty good rally. It's kind of hard to pin down, one specific issue given all the noise that's out there, but maybe just feeling in general from investors has been, a big part of the conversation.
Right. I think right now this is kind of at the moment where winds are starting to pick up. We're starting to feel it after a week like this. Certainly talking to clients a lot more and hearing from them a lot more, of course, as your concerns start to pick up, right? And we're seeing, talking, on the podcast last week just about how investor sentiment is quite low, very bearish right now. Consumer confidence, consumer sentiment, all very bearish. But really the markets, S&P year to date is down 1.7%. The drawdown, from the highs, it's maybe about 5 to 6%. Not necessarily reflecting how we all feel. And I kind of, as we were talking earlier, just kind of related that, almost to, last quarter last year where we're looking at consumer confidence, consumer spending and things like that. Very different. There's a very kind of a disconnect between the way we all feel and what's really happening. And you kind of look at the markets right now, and it tells me that people aren't necessarily selling, but they're repositioning, right? They're maybe taking more defensive positions, as you noted, with leading sectors on the year, consumer staples, healthcare, utilities, just very defensive areas of the market. So to me, that's a very encouraging sign. Because at the end of the day, I think what we're seeing right now, I think the dynamics at play is obviously it's a lot of uncertainty, it's not that necessarily everything has turned bad or negative. It's the fear that things may turn bad or negative. And that's a big difference. We haven't really seen the signs yet that or gotten any yellow flags out there, but our imaginations are starting to swirl, and really it's the offset or the impact of, valuations were high coming into this year, and it was a fairly, it was a broadening out market very slowly and steadily, but a fairly narrowly traded market. And, with all the money that has been, invested into the Mag 7 names, especially. So you're seeing, money disperse. You're seeing it start to spread out. And I think I think what we're kind of building in the markets right now is more or less we're pricing in risk. Everything was priced pretty well to perfection last year. I mean, heading into the last month or two of the year, we were talking about, all the earnings growth, right? Forecast of 12% earnings growth, and then potentially, I think we're actually looking at maybe 14%, and then even 12% even the following year in 2026. So you had great earnings expectations to look to. You had possible rate cuts, and now, that's just being called into question. And so that's really where we're at right now is I think this is kind of just naturally, healthily pricing in risk. And we're not there yet because the earnings are still solid. The economy's at this moment still stable for the most part, as far as we can tell. And so no need to hit the panic button yet, but things to pay attention to.
Yeah, I think things to pay attention to is absolutely the right way to put it. And when I have client conversations, the thing I've been pointing to is the number of articles a year ago, 2 years ago, telling us that the 60-40 portfolio was dead, right? That balance didn't work anymore and that you had to do something different because of what happened in 2022. And I think, if anything, what we've learned in the last few weeks is that if you give yourself a little cushion in interest rates, if you allow bonds to do what they're actually supposed to do, which is really just give you some interest and provide some potential for preservation, well, all of a sudden, all those things that we had said didn't work, the 60-40 portfolio specifically, all of a sudden they're proven that actually, if you spread out risk a little bit, and especially if you keep safe money safe, well, the portfolio works exactly as it's supposed to. The balanced portfolios right now, they're not down 1.7% the way the S&P's down on the year. They didn't draw down, 5+% the way the S&P's drawn down from market highs. They've held up okay because maybe, Tom, bonds actually have something to offer all of a sudden.
Absolutely. I mean, this is definitely a different environment from just 2 years ago in 2022 with the bear market. Really, this is the time in which, in all of my reviews and conversations with people is we're pointing right to the, the bottom line number that we all care about. Well, how much are you up? And that they're all basically, for the most part, outperforming the S&P. So here we are with a 50-50, 60-40, or 65-35 split in stocks to bonds, and we're outperforming in all stock index. And the S&P, not only that, but that's heavily growth tilted. So this is the moments when we say that, hey, as we always tell people, we're willing to compromise a little bit on the upside because what we care about, and I think what a lot of our clients come to us for, is that they worry about the downside. That's the part that's not going to help you sleep at night. So very encouraging to see that. And as it relates to the fixed income parts of our portfolio, again, the dynamic is different now than it was just even 2 years ago. We're now coming from a place of higher yields, higher interest rates, provide some cushion, even in the event that we get a shakeup in interest rates. As we share with all of our clients, interest rates go higher, we worry about the hit to bond prices. Well, now we have that cushion. We have 4% yields on average, across a lot of our bond funds, that it can absorb some of that volatility. And that we're certainly seeing in the interest rate markets right now. Obviously, we're highly fixated on stocks. It's a lot more exciting, as I will openly and candidly tell people bonds are boring, but they're necessary. But that is where a lot of the volatility, a lot of the action is taking place right now. And it's been kind of a head spinning last few years in interest rates. And so now we're coming into an environment, a period of time where if things get more unstable, if we see drawdowns, declines, or selling in the either stock or fixed income markets, we're in a much better position to weather that.
Yeah, I think the disservice that we as a profession could have been doing to so many clients was to say, well, 2022 was such a terrible year for bonds. We don't ever want to live through that again, so we're going to give up, right? That we're just going to hold cash. We're going to buy the Treasury bond or the CD because we don't want to deal with the potential for another really bad year in bonds. And no doubt 2022 was a terrible year for bonds, the worst we'd seen in probably 28 years. But if we're clear, we paid for the current stability we're seeing back in 2022, right? You paid the price of higher rates then so that you could enjoy the benefits of those higher rates on your bond funds today. And the worst thing you could have possibly done was give up. It's why we beat our fists on the table and said, I know it hurts, but you've already paid the price. Don't give up on your bond funds now when all of a sudden you have this advantage of higher yields, higher rates that you didn't have then. And so, it's not an I told you so moment, because it's not just where are we today, it's where are we headed. But I think it very much is a reminder that, sometimes the things that hurt the most aren't the thing you run away from, but the thing you run to. It doesn't mean there wasn't a role for cash. We've talked about that on this podcast. It doesn't mean the treasuries or CD bonds, individual securities didn't play a role. But I think it absolutely means that we have to remember the role that bonds play in our portfolio, and that ultimately that balance is key to how we navigate risk, the very risk we're seeing now.
And I think, at least to start this year, this is the reminder of why we're doing what we're doing, right? We're at least reminded of why we have bonds, fixed income. We're reminded of why we have value stocks again, interest-paying, names out there. Even looking at some interesting statistics I've seen over covering stocks or the S&P over the last, 60 to 80 years. With the effects of compounding interest going back to 1960, accounted for about 85% of the S&P's 500's total return. I mean, just a number you wouldn't think about. And not only that, but digging back into the numbers, also kind of reinforcing the need for keeping that balance, spreading the money out, is that on average, according to a 2018 study, 57% of U.S. stocks had lost value over that time span. So it just tells you that on average you're going to lose with stocks. If you're just picking one here from there, 7% of the time you're going to pick a loser. But just a reminder that don't abandon the names. That dividends are certainly an indicator of ability to generate revenue growth, cash flows that they're willing to share with shareholders. That can be good parts for returns longer term and stability.
I think it's more than anything a reminder that we entered the environment we're in now, a more volatile environment and a period of elevated uncertainty, with a plan. And I don't think you change that plan simply because volatility picked up. I think you change the plan if the fundamentals have shifted, and that's not what we're talking about right now. The long-term outlook isn't all that different than it was 3 weeks ago, despite the fact that stocks have sold off the way they've sold off. I think, we entered with a plan for our portfolios, for each of our investors, of here's how you should approach risk. I think the approach really isn't all that drastically different today. Outside of, okay, maybe there's a new opportunity here or there, maybe there's a new risk we didn't see, but that's not a, hey, let's sell it all and buy something different. It's a, all right, how do we tweak along the way to make sure that we're still best positioned? Joel, interesting week overall for the economic data. Some numbers that I think on occasion on the surface look okay. I think when we dig a little deeper, we do see the occasional crack in the foundation. Nothing more clear there than something like the employment number we saw today. It's a perfectly fine number. The president rolled out a celebratory, hey, everything's great, and look how good, the labor market is. And I think for the most part, a 4.1% unemployment rate is something to be applauded. A claims number that wasn't terribly high, I think, is a pretty good sign as well. But some signs in the underlying data that it isn't all roses, and we got to pay attention.
Sure, yeah. Not only that 4.1% unemployment rate, which is historically relatively low, and we've been trading within 4 to 4.2% the last year or so. So it's steady. And then also last month, employers added 151,000 jobs. It was the 50th month in a row that they've added jobs. Only once before since 1939 has there been that long of a streak of employers adding jobs. So, on the surface, the economy looks pretty healthy. We also had reports this week from the Institute for Supply Management on the manufacturing industry and the service industry. Both of those are expanding right now. So on the surface, things are doing pretty well. But I kind of took a look at some of the other things, more in the details of what we saw. And the jobs report today, for instance, I always bring up the temporary help number, which is usually a harbinger of hiring trends, and that's now down 20% from where it peaked in March 2022. So that potentially isn't good. The average work week was 34.1 hours in February, and that's the lowest. That actually didn't change from January, but it's the lowest since March of 2020, right? I mean, for the first month of the COVID pandemic. So that's low. That's not a good sign. And then there's another number called the U6 number, and it's a measure of underemployment. It takes into account not only the unemployment number, but other things like people who aren't in the workforce, not considered in the labor force because they're not actively looking for jobs and so on. And that reached the highest point in 3 years, more than 3 years. And it's also been above the pre-pandemic level for 16 months in a row. So those all are signs that we need to not feel real confident or overly optimistic, I guess, about how strong the economy is. We also had a report this week on the trade deficit. And this number fluctuates a lot, but it reached a record level in January. It was $131.4 billion. And so that means that, that's the gap between the amount of goods and services that we export to other countries and the value of all the goods and services we bring in. So that's a big number. It's up 96% from a year ago, up 34% from just December. And it detracts from the GDP is the bottom line for that. That's a number that actually takes away from the bigger number that we look at when we're measuring economic growth.
Yeah, and of course the long-term implications of tariffs probably played a role in more imports coming in January. The uncertainty over where we head going forward is certainly going to add some volatility to those numbers, I think, month to month. But realistically, if we're talking about an economy that might be slowing a little bit, that trade deficit's not going to help first quarter GDP numbers. Given that it's increased.
Right, and all of the new policies that are taking place really aren't showing up yet in any of these numbers. What might be showing up is the uncertainty that's being created from the talk and the early implementation of some of those policies. And so, like the ISM numbers, those are based on interviews and surveys with supply management professionals, and in both the manufacturing and in the service indexes, there was a lot of feedback of uncertainty, wondering, how tariffs might affect their businesses and whether that would be good or not, and short term or long term.
Yeah, probably have to keep the running count of how many times we use the words uncertainty and volatility near term. But, realistically, it is the environment we operate in. The Fed is acknowledging in a lot of their comments recently that they're trying to navigate that uncertainty as to what that means for interest rate policy, and maybe transitioning a little bit away from what had been a hyper focus on inflation towards bringing back the full employment part of the conversation. You had comments from a couple of different Fed governors that said, yeah, we probably don't need to cut just yet, but going forward, we are going to pay a lot more attention to labor market strength, maybe than we had in recent history. And I think that's instructive of how the economy has shifted, that the overarching concern is no longer prices. It is now, okay, let's focus on the employment stability piece, because prices probably aren't going to be controlled much by rate policy anyways at this point in where we are in the economic cycle.
Right. There still are concerns about inflation, and we saw that in a lot of the consumer confidence and the consumer sentiment numbers that Tom referred to before. And it wouldn't be a podcast without mentioning that consumers and their spending drive 70% of the economic growth in our country. So that's why the Fed has to be concerned about the labor part, because if people don't have jobs, if they're losing jobs, then they're not going to be as confident to spend money.
You know, Joel, I think we've probably checked all the boxes on our bingo card today, but we do have a newsletter coming out. And so just a couple of reminders. One we hadn't hit yet, but which we normally get on our bingo card for the podcast is something around internet security, cybersecurity, a really good piece, I think, in this latest newsletter, something that's hit me directly with respect to, and I know hit you directly with respect to some text messages you're getting on maybe failing to pay some tolls.
Yeah, I was with somebody last week, and I looked down at my phone, and there was a ping, and there was a message saying that my car had violated some tollway stop, and they needed to collect the money from me before I got fined and whatnot. And I barely looked at it and just deleted it and told my phone to consider it junk, because I had already read that was happening. But enough people haven't that they're still continuing it, and they're still getting people to respond to it, which you shouldn't do. Even opening it up to read it is a bad idea. So.
Well, and as someone that spends a considerable amount of time in the great state of Illinois, I do regularly have tolls that I pay. I did have a time where I drove down without my iPass and had to go back and pay by plate in the app. And so even more reason for those that are regularly making those trips to be extra vigilant. Log directly into your pay by plate account, log directly into your iPass account if you're questioning it. Don't click on the link in that text message, and that goes for just about everything. Unless you're expecting it, unless you are drop dead confident that it's for you, I'd go directly to the source rather than clicking through those links.
It was more secure when you had to, slow down and drop coins into those little chutes.
Until you dropped a coin thinking it was in and started to pull forward. And more than once, I'm throwing coins over my shoulder, hoping they fall back into the basket. So I'm sure that one will resonate with just a few of our listeners. Also in the newsletter, a great piece from Steve talking about the strength of the dollar. Interesting and I think timely in that we've seen some dollar weakening this year that has hinted at exactly what Steve was getting at in the article, which is there may be some advantages as we see that trend shift towards non-U.S. investments. But, Steve just hitting broadly on kind of, okay, what does this mean? What does it mean for investors?
Right. And it was interesting because when he wrote it, the dollar had peaked by one Federal Reserve index that measures it against several currencies around the world. And in the month of February, it started to, as you said, it started to recede a little.
Timing is everything, right? And revisiting something that we put out in 2013 about the penny. Maybe we were a little early in terms of our own, although we were having the conversation at the time about getting rid of it. But interesting that all of a sudden we're having more conversations about the role the penny plays in our spending.
Right, yeah, one of the federal executive orders is to stop making new pennies. So, back in 2013, that long ago, we were just looking at it as one of our for what it's worth pieces on the word penny and where it comes from and how we use it. So
I always find those so interesting, and I think a really interesting conversation shaping up about if we're going to do that, how do we get there? And then the next question is, well, the nickel costs more to produce than the penny does relative to its worth, and so do we go the next step and just get rid of that? And I think it's a pretty slippery slope, but one that's a fun debate, a fun conversation.
Well, then all those expressions too, like penny pinching, will just sort of, people will scratch their heads and say, why do we say that? Where does that come from?
It's going to be dime pinching from here on out, which has a very different connotation, I think. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.